Welcome to the Utilization of Money podcast with Todd Levine from Levine Financial Group. In this podcast, we teach our clients how to own their personal economy. Join us on this journey where we build upon your greatest asset as Todd draws from his years of expertise, solutions, strategies, and expert guest stories to help you understand how money works.
Hello and welcome to Utilization of Money with the team from Levine Financial Group. Today, Ben Duronio and I are talking about student loan management. Hello, Ben. How are you?
Doing great. Can't complain.
Fantastic. Well, student loan management, I think that's something that is a huge topic. Right now, I think that it's probably really, really important. I know that there's a lot of loan, not forgiveness necessarily. I've actually heard that out there too. Loan forgiveness. I've heard that a lot of student loans are being put on hold because of the whole COVID and the pandemic thing. And there's all sorts of stuff that people don't know. And the fact that I know that there's a tremendous amount of debt out there by students all over the world and all over the United States specifically for our situation. And there's job losses everywhere. So a lot of people are really concerned about this. I love this topic.
Yeah, absolutely. And this is something near and dear to me myself as a person who got my undergraduate degree and MBA. Primarily utilizing student loans. So this is something I personally have a lot of familiarity with, which has been helpful whenever I'm interacting with my clients and helping them guide them through how to manage their loans in the most appropriate way. You know, we've seen a lot of people who have student loan debt, especially if they're in the legal or medical practices. And it's really one of the main things that they're concerned about whenever they reach out to us. And there's been a lot of really big changes that have been occurring in the student loan world over the past number of years. And it's definitely a big topic, especially again, given like the COVID situations, things like that, like things are changing politically, things are changing. Different candidates that were, running previously had different platforms around this. This is actually a primary piece for a couple of them. So things are really changing in this world, and it's really important for our clients to really understand that. And it's something we spend a lot of time with, just like we do in every component of their financial world.
Yeah, I heard a lot during the time that certain people were running saying that they want all education to be free, all post-high school education to be free because everybody needs that. And I agree, post-high school education is incredibly important. But I was thinking, man, all the people that have graduated within the last 10 years that have thousands, tens of thousands, hundreds of thousands of dollars in debt, that's probably not going to sit well with them. And then how are we going to pay for all this? And it's just a mess to muddle through when you look at the media portion of it, as far as, the taglines and, clickbait that people are putting out there. So I'm glad that you were going to get a solid base here today on this podcast, just about, here's what the deal is. Let's talk about it. So where do we start today?
There's a few different places we could. I think the primary place to start is just understanding the scope and where people are at in terms of what types of loans they have whenever they come and meet us. So typically we have clients, again, in all facets of types of industries and things like that. And they come to us with different types of student loan debt, some private and federal. And there's different stipulations and different ways those loans work. Federal has some more forbearance options, typically lower rates. Neither of them can get discharged in bankruptcy, which is really important. It's really the only debt that can't get discharged through bankruptcy, which is a big deal. And so it means you're going to have to handle this in a very appropriate way. And understanding the client's specific financial world with relation to their student loan debt is really important too, based off of like how much debt versus how much income they have, how important it is to keep those forbearance options there. Especially in times like right now, thankfully, they've made some changes in forgiveness options and things like that are occurring right now, but that might not always be the case. So understanding what options are there are really important, and the differences between private and federal, and the interest rates that you have, it's really important. Most people have no clue what their interest rates are. They're just paying the monthly balances, maybe even a little bit more, with no real agenda or understanding of how this is going to work over time.
Yeah, that's so important because there's all sorts of loopholes and little tricks and things that just people don't know unless they do a ton of research, and who has time for that, really?
Yeah, and it's really confusing, and it changes a lot. There's a lot of government programs, like right when people start getting out into the workforce, especially if they're doctors, right? Like, so a lot of doctors graduate from medical school. Now they're working as maybe residents, and they're making a small portion of what they're going to make in the future, but they still have to start paying their student loan balances. And How do they do that most effectively? What types of government programs are there? There's revised pay as you earn. There's reduced rates, depending on, again, if it's private or federal. So helping them understand what options are there and moving forward with those. Those are the things that we really dig deep in with our clients that have significant student loan debt, which, is a decent amount of the younger population.
Yeah, absolutely. Can you tell me, I've never heard of revised pay as you earn, I think is what you said.
Yeah, that's a government program. Again, who knows if it's going to be there forever or not? But essentially, it's kind of like pay as you go. Maybe somebody's supposed to pay $1,000 a month, but their income doesn't show that they have the ability to do that. So they pay a smaller amount than that. The interest rate doesn't change. The interest keeps piling on, but as they make more and more money, they'll pay more of the balance back, and it'll basically grow the amount that they pay each month. As they make more money each year, and they have to refile and things like that. But sometimes it's a very effective way to not contribute your entire salary or a large portion of it to your student loans and still be able to do the other things that we're trying to accomplish in your financial world. The big problem that people have whenever they come to student loan debt is they want to get rid of it as fast as possible, which mathematically makes a ton of sense. The issue is if you're only focused on paying down the student loan debt and you're not focused on saving and building up wealth, is that whenever there's an issue or an emergency, you can't then go back to your student loan company and say, hey, can I have that extra cash back? They're like, no, it's here now. You don't have that option. So planning this in the right way and kind of building up savings and paying down debt strategically, that's the really big key in it. And it's something that is a little different than what you hear out in the world most of the time, because most people just see the interest rate attached to the debt and they're like, get rid of it as fast as possible. But there's really a large value in having cash on hand as well. It kind of puts you in the driver's seat rather than the student loan provider.
Yeah, absolutely. I can't imagine that phone call trying to call, a debt collector and saying, hey, can I have some of that back?
Yeah.
Or loan provider, I would say. Yeah, I'm sure they've received those phone calls before. Yeah, I'm sure they've received those phone calls before, but my goodness, that would be tough. And you don't want a doctor having to walk to work, 10 miles each way because they can't afford a bus ticket because they're paying more than their salary, on their student loans. So it sounds scalable. It sounds like it's a good program if that's something that people can get into. I know that you have these conversations with the people that come in, whether it's maybe parents of young people that are going through college or going to go to college, grandparents who are concerned and want to help their grandkids. And also, like you said, you talk to a lot of young people. You specifically, I think that's more of your focus. Are there refinancing options that they can do if they're running into some serious hard times or just even maybe they have a full-time job, but it's just not the salary they were hoping for or expecting at this moment in their career? What are some other options for them?
Yeah, so it actually almost works the other way. It's interesting because when you really want to refinance is when you're in a really good position, when you're in a really stable position and you have good cash flow, you have manageable student loan debt. It's not more than your salary, for instance. You're not making $100,000 with $100,000 of debt. That's not really the ideal place that you would want to refinance the loans for a couple of reasons, which I'll get into. The main people who really want to refinance end up being people who have it in a really good position where they're in control and they just want to lower their rates or extend the term to be able to have a lower monthly outflow so that they can save more money and put money into the market and put money into more creative places than just paying down their debt. Those are the ideal situations. But most of our clients come to us and say, hey, I've heard about these companies that are doing refinancing. I really want to do that. The issue that they run into if they move forward with refinancing when they don't have a great foundation with their finances is that you lose a lot of the benefits that you could have by keeping them with your normal provider, meaning like the forbearance options. With the federal loans, there's pretty long forbearance options. So if you run into an issue, you cannot make payments and you're not going to default on the loan. But if you refinance and you go to a private lender, you miss a payment, you're in default. So there's some serious concerns if you don't have a really good foundation to your finances if you move forward with that. And a lot of people, there's a lot of different companies that have came out in the past 8 to 10 years that are doing this. And it's great, but most people don't clearly understand what they're giving up by refinancing. So there's pros and cons to each side of it. It needs to be in the right position. And these are the things we help coach our clients through. Because most everybody thinks like, oh yeah, I should definitely refinance. I'll get a lower rate. But what are you losing by doing that? And that's a really big factor depending on what your finances look like, what your projected income looks like and things like that. We want to do it strategically and at the right times.
Yeah,
And there's different
absolutely.
ways to refinance too. Most people are just looking at it through refinancing through your own, through a different institution, through another financial institution. There's many out there, banks, so forth. But there's different ways to do it too. I've seen a couple people and we've talked to them about rolling it into their mortgage to be able to get a lower rate.
Really?
Or, to be able to pay that down and still stay on the yield curve, which is really cool too. There's a lot of attractive features to doing that, where you end up paying a lot less than you would if you just paid the money to the lender directly. So there's a lot of different refinancing options. Some are more attractive than others. But in general, we don't meet with clients and just say, yeah, definitely refinance this like 100%, because it really depends on their financial picture.
Yeah. Okay, I'm going to stop you. You said things there that I've never heard before. Rolling it into a mortgage, number one, that's crazy. I've never heard that. That's very interesting. So I'm going to have you expand on that because I need to hear this.
Yeah, let's go ahead and break a couple of those down. For instance, rolling into the mortgage, depending, again, this is not broad-based advice. This is just specific to the individual. So in scenarios where you're getting a mortgage, you're putting down a good down payment, typically the rates are really low. And you see scenarios where people are paying, 6.8% or higher on their student loan debt, which is, given the current interest rate environment, really, really high. So if you're able to roll that debt into your mortgage and that's extended over a 30-year period, again, depending on the size and scope of the student loan, you can save a lot of money by doing it that way, which has been an attractive piece. The be your own bank concept is something that we really focus on. This podcast is called The Utilization of Money, and one of our key concepts that we help our clients create is this banking on yourself rather than relying on financial institutions to get access to capital. So with the cash values of life insurance, there's assets that are being built up that you can collateralize. And even when you utilize that money, you continue to receive dividends. So by doing that, you're able to loan yourself money from your cash values of your life insurance, pay your student loan, but you still receive dividends on the cash values of the life insurance. It's a little bit complicated without understanding the entire scope of cash values of life insurance, but this is something we help a lot of our clients with, and it makes it a really attractive piece to either refinance debt or to utilize for other advantages in investments and so forth.
Absolutely, that is fantastic. Now I'm gonna go back to the mortgage thing because this still is very exciting to me, especially like you mentioned with interest rates at an all-time low with where they're at right now. I know I've got a couple people that I've worked with in the past and I work with currently who've let me know that they refinanced their home back in the fall of 2019, and they actually have refinanced it again within the last month or so because of how low the interest rates are right now. So if people are looking to refinance their home, is this the opportunity to roll that student loan debt into a refinanced mortgage? Is that possible? Is that something that people need to be thinking about right this moment?
It definitely could be, and a lot of it depends on the interest rates that they're currently paying with their student loans. You see this a lot with credit cards when people have high interest credit card debt of like 20, 25%. Mm-hmm. Rolling it into your mortgage makes a lot more sense because your mortgage is going to be significantly lower, and you're extending it over a much longer time period. So there are advantages to it. It's very specific. We don't, again, broadly recommend, hey, roll your student loans into your mortgage. It's really specific on whenever it makes sense. Typically, we don't actually recommend it. We're just saying these are ideas that people should be considering.
Yeah, absolutely.
Rolling into the mortgage is definitely an option. The using the cash values, it's really the same concept, but you're really relying on yourself rather than utilizing it through your home.
Mm-hmm, mm-hmm. All right. Well, where do we go from here?
The one thing that we really see a lot of with our clients, we're always working with our clients' cash flow. Like we really put ourselves out there as income management, cash flow management professionals. That's what we help our clients with day in, day out. And one of the things we really see are people, again, when they have student loans, it's almost the biggest thing in the world to them, other than their family and maybe their job and stuff like that. But it's really, really big and top on their mind, no matter if they have $10,000 or $300,000 of debt. It's really important to them. Every time I meet with somebody who has any student loan debt. And a lot of them want to get rid of it as fast as possible, which makes total sense. So the conversation ends up being how much should they be contributing to the debt versus saving? And the way we always explain it to our clients is that you're more important than your student loan lender or your credit card or whatever else. We really need to focus on savings. And if we're able to look at the interest rates and see that they're not that high, maybe we are able to refinance them, it doesn't make a ton of sense to overpay to get rid of that debt quicker than it does to potentially save that money and put it into an attractive place where you're able to grow and create wealth for yourself. If the interest rates are 3.4 or something like that, why are we overpaying that debt instead of putting that money to work somewhere else that could be more effective over the course of your working life? We want to pay it down, but we want to put you in the driver's seat, the client, being able to create their own savings, build a nest egg, an emergency fund, and then an opportunity fund where they're able to, take advantage of whatever opportunities come across their path over their working life. If they're only focused on paying down the debt, they miss all those opportunities. They're never able to invest in real estate or businesses or put more money into the market when there's lows and things like that. So there's a lot of, negatives that come from overpaying them aggressively. And it's something that we have to coach our clients with, because a lot of the times they come to us and they're already doing that, or they think that's definitely the best way to go. And sometimes it is, but for the most part, it doesn't make a ton of sense to overpay the student loans if you're sacrificing how much you're able to save, in order to do that.
Yeah, there's two things I want to touch on that you said. One of them was the term opportunity fund. I love that. I don't think I've ever heard that from your team at this point, but an opportunity fund, that is a perfect way to put it, because like you said, if you don't have something like that set aside, you lose those opportunities to where you could invest in something, whether it's real estate or even into your own family for different things. So I love that term. And then secondly, I know that in the past, in podcasts before, Todd and I have spoken about kind of those opportunities that people have. And if you're paying off debt, like you said, if your interest rate on your student loans is 3.8%, is there any way that you could possibly make more than 3.8% if you're investing wisely? And most likely you probably can. And so that's kind of the rationale for not paying that all down, because you're going to be able to make more money with the money that you save from not paying it off early. But let's say your student loan debt was at 10% interest, which would be insane. I hope nobody is experiencing that at 10%. But
I've seen
it possible?
It exists.
Oh, seriously? Oh, that's
terrible. For sure. I've seen as high as 15.
That's okay. That's criminal, in my opinion. I'm just going to say it out loud. That's my opinion only. Eric Johnson said that, my opinion, but that is just ridiculous. Because then, if you're at 15% or you're at 10%, it's probably wise to pay it down as quickly as you can, because it's a lot harder to make 10 to 15% in investments. And so it's just kind of that rationale. And I know your team helps people navigate that. So anyway, I know that you're going to get contact information at the end of the podcast, but I can't believe you just told me that 15%.
Yeah, it's crazy.
That's painful.
When we look at student loans, typically we're seeing, somewhere in the 3 to 6, sometimes 8% range, which, again, we don't want debt. We're really conscious about not having, excessive debt on our clients' balance sheets, but we want it to be strategic, and we want to make sure we're doing the right things in terms of focusing on building wealth first. If you're able to do that, you can wipe out these loans, no problem. If we're only focused on that and you never are able to take advantage of the things that cross your path, that could be really damaging over the course of a working life. And you may never really experience it, because you never noticed that you missed those opportunities. You didn't even consider them because you didn't have cash on hand. This is an area that a lot of people, they're not as focused on as they should be. This is an area when we're going through our clients' consult packet and really coaching them, where we typically find a lot of cash flow that's available to be redirected into more favorable areas where they are able to earn a better rate of return and keep that liquid bucket available for emergencies or opportunities. One of the reasons that the government needed to step in during this time is because most people, what they're doing is they're putting all their money to their student loans. They're not saving anything. If they are, they're saving it to a completely illiquid bucket like their retirement accounts. So they end up in this scenario where they have no liquid cash. They have student loan balances where they're putting all their cash flow, and maybe they're saving into their 401ks. It's not a real favorable place to be in. There's no liquidity. There's no emergency fund, or again, like an opportunity fund. There's none of that. All they're doing is, paying down debts and building up an asset that's completely not utilized. So the government had to step in to be able to, basically say to people, you don't have to pay for a time period. And that only really was there for government, federal loans rather. For private loans, there are some stipulations that are out there right now, but you had to be, again, it depends on the lender. But in general, from what I've seen, is that you had to be affected by the virus, meaning like you had job loss or you actually did get sick in order to qualify for any kind of, pause on payments for that. The other factor is, like we mentioned, politically, there is a lot of conversations out there about loan forgiveness on a couple different areas. There's military loan forgiveness. There's different types of forgiveness depending on what type of job you have. If it's nonprofit or if you work for the government, there's a time period where you're able to work for a certain amount of time and end up getting it forgiven. These are all really changing pretty rapidly. And again, politically, over the next 5 to 10 years, a lot of things could happen. So imagine you do overpay that debt and you're really focused on it. You pay it all the way down, and then they say, you know what, we're getting rid of student loans, which has been actually talked about by people, again, that were running for president. Who knows if that would go through or not, but it is in the conversation now, again, more than it ever has been. So keeping that liquid bucket gives you a lot more flexibility than just focusing all the way on the debt and only focusing on that, which, again, mathematically, people look at the interest rate there versus a savings account or some other vehicles, and they're like, yeah, that makes sense. But is it worth sacrificing the liquidity and opportunities and emergency fund that you really want to have in order to create wealth over the course of your life?
Yeah, I'll tell you what, that's, you said it best. Over the next 5 to 10 years, we have no idea what's going to happen. But there is one thing that we have to talk about near the end of this podcast because we're running low on time. But we know that with everything that's gone on, with all the different stimulus checks, with all the different forgivable loans to small businesses and things like that, there is a tremendous amount of debt being added to the national debt. And eventually, we're going to have to get that money back. And the government does that by taxes. So how do taxes affect what you're talking about today as far as student loan management?
Yeah, it really depends, again, on the individual. There are deductions that are available through student loans based off of your adjusted gross income and things like that. And, just to specify, I'm not an accountant, but, there are certain deductions that come up to $2,500 if you're making $70,000 as an individual or less, as a couple, $140,000. It actually goes all the way up to like $170,000, I believe. But you don't get the full $2,500 deduction. But it's important to know this, and also how you file affects that too. If you file married but separate, like some people think like, oh, I have these student loans, I don't want to file my taxes together with my spouse because, we haven't really tied things together because I have this really big, enormous student loan debt and I don't want her to be a part of that. They think that's the good strategy, but little do they know, now they can't deduct that interest. These are just the things that, people don't know at all about student loans because, you can qualify for one at 18, no problem, but you don't really get a handbook on how to manage them once you're out in the real world. And again, just like all the things we help our clients with, student loans are a really, really key part, especially if they have a large balance. I've seen doctors that are married together that over $1 million of student loan debt together. It's going to be a big part of their life for a long time. How they manage that will really dictate how their life works in terms of being able to accomplish all the things they want to accomplish, being able to send their kids to school, hopefully without having to have them get into student loan debt, and to be able to retire how they want to and when they want to. So managing the student loans is really, really important, just like every other component of the plan is. We talked in our last podcast that I was on about disability protection. It's really important for a lot of reasons, but those student loans still come if you're sick or injured and not working. There are stipulations around that, but you have to be really, really out for really good in terms of like a sickness or injury. Not quite the same level of like, not creating income for 7 to 8 months because you're out of work. Those student loan bills, they keep coming. So, having the proper infrastructure in place is really key. And these all get coordinated together. And that's one thing that I think, again, people come to us with specific issues, but when they really look at their entire financial picture, they have some aha moments where all the stuff gets tied together. And how they manage one decision, again, like overpaying or not overpaying their student loans, will really impact another, like being able to buy a home or invest in real estate or things like that. They don't realize that they're sacrificing one or the other sometimes, which is something they should realize for sure.
Yeah, absolutely. All right. And I just want to address the audience real quick. If you have student loans, think about how long ago you signed up for those student loans. You filled out the paperwork, you secured the loan. That could have been 5 years ago, 10 years ago, 15, 20 years ago. Do you know what your interest rate is right now? Do you know what that is? Has it changed over time? Was it fixed one time and that's just it? Are you positive you know what that interest rate is? Please, please, please pull out the paperwork or get online, find out from the lender what your interest rate is right now, and then be prepared to call, because Ben and his team have a lot of tools, a lot of resources, and a lot of great information for you. Ben, where can they reach you if they take a look and they're like, oh my gosh, I had no idea it was that high actually, or that's different than what I remember. I need to talk to somebody about this. How do they get a hold of you?
Yeah, my email is the best way to reach me. Ben_Duronio at levinefinancialgroup.net. We're always here to help. Especially with these kind of items. I work with tons of people that have student loan debt in their 20s, 30s, sometimes even 40s. So this is an area that we have a lot of expertise in. Again, I had student loans myself. Undergraduate and MBA. You can imagine it was a pretty big portion of my early going. And that if I didn't manage them the way that I have, I would have a much different financial picture myself. So I get it. It's something I lived through and my generations lived through. And navigating this in the most effective way, it's really, really crucial. It's not just set it and forget it. If people are acting like that, they're kind of putting their head in the sand, they're missing a lot of opportunity and probably not taking advantage of whatever programs or refinancing options that are actually available to them.
Yeah, absolutely. We will put Ben's email address in the summary notes for this podcast, so you can go right to the summary and take a look and should be able to click right on that to contact him. But for those playing at home and listening, it's Ben Duronio, BEN_DURONIO. So thank you very much. I appreciate your time, Ben. Always a pleasure. And man, this is great information that people need to hear today. So I thank you for being on.
Oh, thanks for having me. I really appreciate it.
You bet. And thank you all for listening to the Utilization of Money podcast with the team from Levine Financial Group. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when the team comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thank you so much for listening today. For everyone at Levine Financial Group, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Utilization of Money podcast. Click the subscribe button below to be notified when new episodes become available.
Ben Duronio is a registered representative and financial advisor of Park Avenue Securities, LLC PAS, OSJ 120 Broadway, 37th floor, New York, New York, 10271, 212-701-7900. Securities products and advisory services offered through PAS, member FINRA SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is a wholly owned subsidiary of Guardian. Levine Financial Group is not an affiliate or subsidiary of PAS or Guardian. Guardian and its subsidiaries and agents and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. Material discussed is meant for general informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. All investments contain risk and may lose value. Past performance is not a guarantee of future results. Life insurance dividends are not guaranteed. They are generally declared annually by the issuing company's board of directors. Some whole life policies do not have cash values in the first 2 years of the policy and do not pay a dividend until the policy's third year. Talk to your financial representative and refer to your individual whole life policy illustration for more information. Cash value accrued over the years in your life insurance policy will be an asset at your disposal that you may withdraw or borrow from to assist you in financing a life event or even help supplement your income during retirement. The withdrawals you make or any outstanding loans or loan interest you have will then simply be accounted for in the payout of your policy's death benefit. Guardian and its subsidiaries do not issue or advise with regard to student loans, mortgages, or real estate.